Great. Hello, my name is Daniel Gorfine, and welcome to our panel today, where we're going to discuss a range of topics related to the state of small businesses in the U.S., their access to financial services, and how financial technologies and fintech companies are helping to provide and fill gaps in providing those services. We have an excellent group of panelists here today who bring a diverse set of perspectives and experience who will help us with this discussion. So with that, let's go ahead and jump in. And David, I think I will start with you. So set the scene for us. I mean, tell us a little bit about some of the gaps in small business financing that kind of resulted in the founding of Bluevine. And how are you all using technology to help fill some of those gaps?
Sure. So I think, before we jump in, it's probably important to understand there's in terms of the size of the market, over 30 million small businesses in the U.S. that provide about 50% of the GDP and about 50% of the jobs. So it's a really big market. And those are firms with less than 500 people. So it's a meaningful size. Something that we've seen over the years is that the small business needs are just not being met by the existing banks today. And this is across a number of dimensions. It's across the fact that the fees are high, the service is particularly low, and I think money movement is generally very slow as well. And I would add on top of that, from a lending perspective, we know that only around 20% of those that apply for a loan are actually approved by the traditional banks. So access to capital is extremely limited. So from a gap perspective, this is really the problem statement that we've seen over the last few years. And I think it's been tried to be addressed by a number of fintechs across the board. You've seen this real fragmentation. You've seen individual lenders pop up. You've seen individual credit cards pop up. You've seen individual firms doing money movement. So they're all trying to provide point solutions. And it's led to a really fragmented market for SMBs. It adds time. It adds complexity to their already busy days. So what Bluevine does differently is we bring financial technology directly to this problem. So essentially, Bluevine is a digital provider of small business banking needs. We provide credit, and we provide money movement and bill pay in a one-stop shop. So we are just purely focused on providing for SMBs. And we do that really for companies between 3 and 20 people. Right? So it's really that smaller firm, less than 5 million in turnover, that are non-commercially banked. And that's really the segment we've had, we've heard the most of the issues with these smaller groups, and we've had great success at that. We're reaching a lot of the community in terms of LMI, reaching a lot of communities that aren't traditionally reached by banks using the application of these technologies.
Excellent. So, Connie, let me turn to you. You're the head of one of the largest CDFI trade associations that focuses on small business. But for the audience, first, tell us a little bit more about CDFIs. What are they? What do they do? And how do they help serve an underserved segment of small businesses?
Sure. CDFIs are community development financial institutions. How many know CDFIs? Oh, great audience. Most of you already know this. So CDFIs, as you know, provide mission-based capital in low-wealth communities based on census tracts. They are certified by the CDFI Fund at the Department of Treasury. There are about 1,700 CDFIs around the country. The smallest portion, one of the smallest portions, are those who are doing small business lending. Some are banks, some are credit unions, some are revolving loan funds, and then, of course, there are some venture funds that are CDFIs as well. We focus on those who are doing small business lending. And again, they're providing not only the capital, but the trusted relationships. That's literally their bread and butter, right? Is the trusted relationships deep in low wealth communities where they can actually reach entrepreneurs, serve them not only with capital, but what we call trusted guidance. And now that trusted guidance may go deep or it may be pretty thin in terms of just helping to get a loan package ready, but it is providing some of the services that business owners are looking for.
Great. And excuse me, let me turn to Sabrina. So you've just heard from Connie and David about access to capital being a key challenge for small businesses. Now, you've done some groundbreaking research on Fintechs, their ability to reach underserved small businesses during the pandemic period. Can you share with us some of your findings from that research and takeaways?
Yeah, I'd love to. Thank you. So I came to this project motivated by the observation that Fintechs brought, I think, two really important innovations to lending. One is algorithmic underwriting using machine learning tools and new data to gauge credit risk. And the other one is process automation. And these technologies raise important questions about their implications for racial disparities in lending. And there's some existing work in economics, I'm an economist, about the role of algorithmic underwriting. But there really hasn't been any study about process automation, maybe because it's less sexy. But that's what we do in our paper. So what is process automation? It's removing the human from the loan origination process, automating application intake, income and payroll verification, fraud checks, even just having a simpler UX with better FAQs so there's sort of less customer service interaction. We are able to isolate the role of process automation by holding fixed credit risk and factors that tend to be correlated with race but are not fully observable, like credit risk, by studying the Paycheck Protection Program, which, as I'm sure most of you know, is a more than $800 billion program to help small businesses in the pandemic. We develop a data set of about 4.2 million first-time PPP borrowers, and we show that more than half of Black-owned businesses that got a PPP loan got it from a fintech. That finding is probably why I was invited here today. And even though fintechs made only about 17% of all the PPP loans, and then among traditional lenders, we show that the rate of lending to Black-owned firms increases with bank size and measures of bank automation, including actually bank branch level data on software spending. So more automated branches, as measured by software spending, are lending more to Black-owned firms. So we do a lot in our paper, but I want to just tell you about one more analysis, which is really important because it brings some causality to bear on this question. So we show in a set of small banks that automated during PPP by outsourcing the back end, but not the front end of their PPP loan origination to third-party white label fintechs, that after they automated, they increased, roughly doubled the rate of lending to Black-owned businesses. And that analysis is within bank, and it controls for time. And so it has a causal interpretation, and it shows that automation actually increases lending to Black-owned firms. So I'll leave it there, but I'm happy to talk more about that project and other research folks have done.
So you actually have me too interested to, I think I need to follow up on this now. So there's a deep dive that we need to do into the why. So you're identifying that automation seems to have a causal relationship. What is it about automation that's expanding access? Because that's not the underwriting piece per se.
Right.
It's the automated front end, back end that's doing something to increase access. Why?
Yeah. So we explore three reasons why automation might increase lending to Black-owned firms. And I should say, by the way, I didn't mention this, but I keep saying Black-owned firms. That's the focus of our paper because that's where the disparity is by far the most striking. So we look at gender and we look at the other racial and ethnic groups, and the really big striking disparities for Black-owned firms relative to actually all other PPP borrowers. So that becomes the focus of the paper. Okay, so why? We explore three reasons why automation would increase lending to Black-owned firms. One is that it lowers the fixed cost of making a loan, allowing the lender to make smaller loans, which are then more likely to go to minority-owned firms, which tend to be smaller. Second, automation goes hand in hand with online origination, which allows a lender to serve areas, places, that are relatively less well-served by the bank branch network and tend to have higher shares of minority borrowers. And then finally, removing the human from the process, from sort of decisions large and small, can reduce the impact of racial discrimination or bias. And we amass a rich array of data sets, partnering actually with some fintechs, including Acrolis, Lendio, and Middesk, to really try to tease out what's going on. And we find evidence for all three channels that I mentioned. And importantly, there's an economically meaningful role for mitigating discrimination. So we show that the effect of small bank automation, remember that within bank analysis, is larger in parts of the country with more racial animus against Black people, using 6 different measures of racial animus. And more broadly in the data, the higher chance of Black-owned firms of getting a fintech loan is magnified in areas with more racial animus. And we're able to use the data that we get from the fintechs to rule out a bunch of other sort of obvious explanations you may be thinking about for our findings, including pre-existing bank relationships, application behavior, and fraud.
Super interesting. Okay, so let's do, Connie,
I'm sorry.
go ahead, please.
I just have
No,
one
this
follow-up
is
question on
incredibly
that, because
interesting.
many of the CDFIs during PPP were able to do so much lending because they did partner with fintech companies.
Oh.
And so does your research reach into that? Because in addition to what you're saying, I would think that a piece of the research that would be important is understanding how those fintechs reached that Black audience. And I know that our CDFIs, who serve more of the Black and brown audience, were partnering with with fintechs during PPP.
Yes, so this is an important point, and it is not really addressed in our paper because we don't see, first of all, for the whole PPP, we don't see applications. We see applications for one analysis that we do to the Lendio platform. But in general, most of what we look at is conditional on actually borrowing. We don't see how borrowers are getting to the place where they apply. And I've heard sort of from, in a sort of an anecdotally, that certain types of lenders like CDFIs referred applicants to fintechs, right? And so they said, look, we can't handle this volume, but go over to Bluevine, they can help you.
Yeah. The reason
and so I would say that is an important, could
Right.
play an important role. And we sort of argue, we're able to show with the Lendio application data that when Lendio referred, in the PPP, they just performed this very simple sort of referral process. They didn't do this more complicated matchmaking that they do for marketplace loans. And we showed that when they would pass Black-owned applications to conventional lenders, those applications were rejected at higher rates
Right.
than other applications, while there was no such pattern for the fintechs. And so that tells us that something is going on here beyond just that idea that Black-owned firms were applying more to fintechs, which could explain some of what's happening in the bigger data and may reflect partnerships with CDFIs. Unfortunately, I'd love to work with data from CDFIs, but we didn't.
So it looks like we have a new partnership originating here, which is exactly what we're about.
It's an important piece in terms of where fintechs are able to reach, right?
Absolutely.
It's talking about reach, which it's not addressed, but I think it's an important issue.
So let me do this. We're going to come back to partnerships in a second, but let's step back. And given the current economic environment, we are seeing rising interest rates. There's expectations for a potential recession. What does that mean for small businesses? So David, maybe I'll start with you. I mean, what are you all seeing, hearing from small businesses, and will it change their needs when it comes to credit?
Yeah, it's interesting. I think the rhetoric has changed recently. There's been this disconnect between, I would say, Main Street and Wall Street for quite some time now. In that Main Street is still performing really, really well, despite some of the headlines. I think that's changed in the last few months. What we're hearing from clients and what we're seeing in some of the surveys is there's just a general reduction in business confidence. Expectations for the future are deteriorating. And that's going to take its toll. As consumers start to pull back on spending, that's obviously going to impact the small business. I would say, as it relates to, maybe I'll say the provision of credit more broadly, when I think of it through the lens of fintechs, we've certainly seen a number of fintech partners start to pull out of that lending space at a time when some of the needs are starting to increase. And I think they're pulling out for a number of reasons. Some of those reasons relate to just the fact that rates are increasing and their cost of capital is increasing. The fintechs are obviously not banks, so they don't have access to those deposits. They still are playing in the capital markets where you've got a widening credit spread, right? So I think that's a piece of the story. Another piece is, fintechs are largely in cash conservation mode as well. Yeah. So committing capital to lend and do it on balance sheet is not always the most efficient use of capital. So I think you're going to see some optimizations there. In terms of the product specifically, the areas where I think are going to develop more are really those revolving type lines of credit. I think longer 10-year term loans are going to be largely out. And certainly for fintechs, loans where you have a shorter duration, where you can regularly underwrite, understand what's happening with the customer base. At Bluevine, we do daily underwriting of our
on a line of credit type product, so you can assess the current health.
Yeah, so you have much more of that information. So you have a lot of leading information about what is happening with a specific client, but more broadly within a specific cohort, right? So whether that's restaurants, whether it's construction, like you get a really rich data set to understand what's happening across the board as a leading indicator. And obviously that'll impact future credit decisions that are made.
Sure. So Connie, let me ask you, I mean, from your perspective, same question, and then Sabrina, if you have additional to add on this, anything that you're observing right now about the state of small business?
Yeah, it's really interesting. We just came from a meeting with SBA where we just said exactly what you just said, that what we need, what our business owners need is a line of credit, that even though there's a lot of optimism, they are aware that something bad is getting ready to happen. Another change, another wave is coming, and they need to be prepared. And how they get prepared is through a line of credit. What we're hearing from our CDFIs is that a lot of the small business owners are not ready for capital, not ready for debt. And so many of the CDFIs are packaging like 80% of the capital in debt and 20% in grants. Grants played a huge issue for businesses during the shutdown, during the pandemic economy, but we're seeing that business owners still aren't ready yet to go full debt. And so many of the state programs and government programs are being used to provide grants. And so CDFIs got swamped with a lot of money from private sector as well as the government. And so they are flush with capital, but to get that capital in the hands of business owners, they're having to be more creative and do, again, combination loans, grants and loans, or things like that.
Interesting. Sabrina, any additional points on this?
So I think these two are the experts on this front. But one thing that's interested me is the remarkable increase in business entry since the middle of the pandemic. So there was a spike in exits in the middle of 2020, but it was more than compensated for over the following months by a higher entry rate. And a lot of that was that the closures were temporary. Businesses closed and they reopened. But then this discontinuous high increase in firm births has been sustained through last month, at least. So, and it's like a 40% increase relative to previous years. Firm births go like, and they went, and now they're staying up. And I'm really interested to see if that is sustained in a higher interest rate environment.
Well, and the products for companies that are that early stage is different than a 10-year-old small business, right?
Exactly.
Yeah.
Exactly. And so I think that's actually a good sign. You talked about what is the state of small business. I think it's perhaps not as dire as some folks may think.
Yeah. It's interesting. Like there is a lot of small business creation. I think the type of businesses which are being created may be different this time around as a result of the pandemic. And one thing I would add is, to some extent, the businesses have now playbooks. Like the ones that went through a pretty drastic U-turn, they have a playbook. It's been difficult for them to overhire. It's been difficult for them, I would say, generally. So they've been naturally more conservative. So, being optimistic, it could be a reasonable sign that things are going to not be as bad. But I think a lot of that is up to the Fed right now.
Can I ask how the businesses are different? You said the businesses are different that have been found?
Yeah, I think during the pandemic, a lot of people left and they went and created their own firms, started work for themselves. They have lower overheads. Their cost base is potentially different. And as well as the ones that went through some major distress, they have a playbook now. Right? They've got used in this inflationary environment to raise prices. They have steps that they can take. They've negotiated with suppliers. They've done a lot more to I would say, steady themselves.
I think the other thing that we're seeing, though, particularly, I think this new startup that you're talking about is still being led out front by Black women. And unfortunately, there has never been, I mean, Black women, Black people have been leading the startups for some time. There's no problem in starting. The problem is there's a really short runway because they can't get access to capital most of the time. And so no problem starting, but the question will be how many of them will be able to get access to capital and the resources they need to really take off.
Especially when you don't have demonstrable cash flows from
Exactly.
years of activity. So, Connie, let me stay with you. I mean, you've been an absolute leader in trying to bring technology, fintech partnerships into the CD5 space. Can you talk to us about what you've seen over the years? What's worked well? How can tech partner with CDFIs to better serve?
And who better to ask that question but you do? We've been partners in since On Deck and like in the early startups of the starting period of On Deck. AEO was the first to partner with a fintech company to really bring the technology, the product innovation, as well as the process innovations to communities, to low wealth communities by partnering with CDFIs around the country in our network. We had a great collaboration where it allowed the CDFIs to offer a new product in their community, same value, same speed, same everything, except below market costs. And so while, I mean, we were with On Deck when it was 70% interest rates, and we were able to get that same product into low wealth communities at like 22, 23% interest rate. Plus, we were able to bring our own capital. So while you were chasing VC capital, high expensive capital, we were able to bring low-cost capital to the partnership, which allowed it to work. We brought the trusting relationships, we brought access to a low-wealth consumer base, and then you were able to bring your technology and the underwriting that, you know, was better suited for many folks in our community. So that was one of the first ways we collaborated. And then with the ILPA, AEO worked with ILPA to bring across the smart, I just forgot the name, smart card.
The smart box.
Smart box. And then again, working with that to really talk about the policy power. How do we, and I think you would agree that we were effective in helping to push you guys to actually, you know, stick to some real lack of discrimination and being able to reflect on what you were doing to communities. So it was a great partnership that resulted in something that many of those in our community include. I have one little quick anecdote. I was giving a presentation at the Federal Reserve Board, and two of the leaders at the Fed came to me and publicly apologized. We were the scourge of the earth for years because we were the first to partner with Fintech. And that's when Fintech was seen as, oh, terrible by everybody. But they apologized to us to say we were ahead of the game. We were ahead because of our open thinking and innovation that we did together. And so what we were basically doing is using the strengths, the assets of both partners to really get capital in places that were hard to reach. It was a great partnership. We want more. So yeah, it's a lot of opportunity.
Well, so for David and Sabrina, I mean, we're here in DC, so we should be talking a little bit about policy. From a policy perspective, what would you like to see done on a number of fronts? What can be done to foster partnerships? How do you level the playing field for small business finance? Are there consumer protections that we need to be thinking about incorporating? So, you know, I know we're short on time. We could delve for hours on each of these questions, but what are some ideas you have from a policy perspective? And David, maybe I'll start with you.
Yeah, I mean, maybe I'll start with three quick ones. I think at Bluevine, we welcome transparency and we welcome regulation. I think disclosures is a key area, which can be a good way to level the playing field across the board. So specific disclosures for SMBs, I think, is one. We were supporters of both the Californian and New York bills, which I believe went into effect. On top of that, I think APY, right? Has our API having clear focus and requirements around APY is critical. And then I would say more generally on the policy front, I mean, maybe just to pick up on Connie's point, I think, you know, there is this perception that fintechs are nefarious in some way, and I think trying to break that myth, like get to know what the different fintechs are about. I think the fintechs potentially have to do a better job of that as well. explaining what we do, what our methodologies, what our risk management structures like. There is a great variety in fintechs across the ecosystem, and there is a great disparity, I would imagine, between the risk and controls and governance that they have in place. And I think Bluevine, we consider ourselves one of the leaders in that area, really focused on the governance structure, full BSA programs that we have. So urging the regulators and the lawmakers to really get to know the individual fintechs.
And so, Sabrina, I mean, you have a magic wand here, and you can make policy happen overnight in Washington, because that's how it moves here. What are your suggestions?
Yeah, well, I think a theme that I've heard all day today is that there's sort of a need for a kind of a two-pronged approach. With one arm, fintechs should be brought, roughly under the same regulatory umbrella as everybody else, that there shouldn't really be room for regulatory arbitrage in lending because there are bad actors and there is predatory activity. But that with the other arm, the government, and perhaps I think the Fed might be the most important actor here, should be giving non-banks, potentially, who are subjecting themselves to the same levels of compliance and scrutiny that the regulated banks, the insured banks are undergoing, that they should also get access to resources like payment rails, a future Fed Now, to Fed accounts, to future liquidity facilities. And to go, I think that speaks a little bit to what Connie was saying about the high cost of capital for fintech lenders going to VCs, going to hedge funds. Like a big chunk of the high interest rates that are being charged is is because of that very high cost of capital. So by accessing these, by accessing Fed resources, we can potentially reduce that cost of capital, and I think enable fintechs to access liquidity facilities that may arise in the future. So the PPP liquidity facility was tremendously important in driving, a large volume of fintech lending that happened. They didn't have the balance sheets to fund that themselves, and right now that requires all kinds of special exemptions to allow lenders without Fed accounts to access that. And in a coming recession, to this point about lines of credit, having the ability to provide forbearance could be really helpful. I think that was very important to the lower rates of default at some of the banks relative to fintechs in the pandemic. If you can give a 4-month forbearance, you can actually sometimes get through some of these crises.
So let me stay with a policy consideration. So the SBA is currently exploring expanding participation in the 7A program by lifting a moratorium on non-bank licenses. I believe it's been 40 or so years since the last non-bank license was granted. What might that do? And David, I can start with you. I mean, how do you view the 7A program, and is that a big move forward in terms of expanding access?
Yeah, I think it is. I mean, firstly, we welcome the SBA doing that. I think it shows, expanding the access shows a recognition that fintechs have a part to play, clearly from the distribution standpoint.
And I think Sabrina's research may have contributed to that.
For all the reasons that Sabrina stated. So, I think that's phenomenal. I think fintechs, we talked earlier on, right? We do make smaller ticket loans. We have a more efficient platform. We have the reach. We're not reliant on a branch network. So I think it's a really positive step in the direction for fintechs more broadly.
I think it's not only a good reach and a good condition. We were recently put in our comments for SSBCI, as well as some of these other projects that are coming out of Treasury, as well as SBA. And we think they're all opportunities for fintech to play a role, and making the regulations different and changing those. And it's not all of them require major changes, terms and conditions, and some other things that fintechs need to come to agreement with the government and the legislature. But I think there's real opportunity to access. I mean, there's so much money that got passed through SSBCI, for example. And we're concerned that we actually have a working group because we're concerned that those resources won't actually get into the hands of Black business owners, Black and brown business owners. Fintech can help with that. They can play a role with that. We were also talking about the new rule that you just asked about with the moratorium lift. AEO personally is not interested in becoming a capital provider. We could do it with a partner. And so there are lots of opportunities, I think, in the legislation right now.
That's interesting. Sabrina, last thought on SBA 7A moratorium?
I think as long as the fintechs comply with the same eligibility rules that everybody else does, there's sort of no reason why they shouldn't be able to participate.
Sounds like a good point to end on. So join me in thanking our excellent panelists on small business, and we'll turn to the next.